I'm going up on the stage now. Right. I've got to invite some lenders on the stage. Hopefully we get some interaction here. I've got some questions for them, but they know what they are because they're pre-prepared. So it'll be much more fun if you ask them some questions. So Jeremy, if I can invite you back on stage. We've got Simon Cockerill, Head of Intermediary for Sales Development at One Savings Bank. Come on, Simon. Jonathan Stinton, Head of Intermediary Relationships for Coventry Building Society. Come on down. And Tim Vigeon, Head of Lending for Buckinghamshire Building Society. So come on, guys. So you've heard a lot. This is your chance to have a chat with the lenders. You know, I said earlier that a few hiccups in COVID, but I'm genuinely impressed with lenders, how they got through that and service levels. But what are the hiccups for you? What do you want more from them? Is there anyone want to start with some questions to make sure we get yours out first? No? You're all way too shy. Right, okay. First of all, it's been wonderful seeing you all face-to-face. How are you finding face-to-face personally? And can you have a chat in terms of how are your BDMs finding it, please? And what's the reaction with brokers and how's it working? Jeremy, do you want to go first?
Yeah, our guys have been out since, well, from when they could, when we were allowed back out again. So early part of the summer. Initial response was a lot of brokers were just not quite ready. And that's fine, but we've seen over the summer more and more brokers open their offices up, get back into offices, or want to meet outside the office. You know, a lot of coffee shops, we're doing a lot of meetings outside when the weather is okay, and the general response from our brokers has been really, really positive. I think starting to see the benefits of that face-to-face contact again. Everything's great if you can do it on the phone, if it's simple inquiries, but what you don't get on the phone or on Teams is that ability to just have a wider chat. So the feedback has been when they've been in front of brokers, recently they've picked up a lot more cases, they've been able to discuss concepts of what may happen, some customers that may be coming in, and very, very positive feedback about being back out on the road again. We've changed the way that they work slightly. They're not out 4 days a week as they were, but that balance between Teams or Zoom calls and face-to-face is working well, a slightly hybrid approach.
And Simon, how are your BDMs finding it? Are you keen that they're out there?
Yeah, massively. I mean, that's the sort of bread and butter of what they've done in the past. When you move into the specialist space, I think the face-to-face engagement becomes even more important. You know, we've seen some bumps in the road, so you know, now we're heading into winter, we're having a few cancellations because people are getting poorly again and such like. But you know, we take the safety of our guys pretty seriously as well, and we want to make sure that they're coming out and seeing you guys and being careful as well. But from our perspective, face to face in a specialist world is really important. And the best BDMs are almost like an advisor to your business as well. They can give you little hints and tips of what they're seeing elsewhere. So, you know, I go to Jeremy's point, he's absolutely right. There'll be kind of hybrid engagement with brokers going forward. You know, brokers themselves, you're all working in slightly different ways at the minute. Vastly more people working from home than there were before, and we've got to adapt to that. But face-to-face has still got a massive part to play in what we do.
Brilliant. Well, change tack a little bit. In our lending, we've seen the growth of the Big Six. So the Big Six lenders now account for more than 70% of Legal and General Mortgage Club's lending, and that's grown. How is that impacting you? And as none of you are Big Six, Jonathan, come to you first. What do you think of that, and how are you going to react?
It's, you know, we can see it across the board. When you look at UK finance numbers, clearly there's a lot of additional liquidity in the marketplace, because for the clients who've been fortunate enough to be able to survive through the pandemic, to continue to be able to earn money through that period, you know, there's circa £200 billion worth of surplus liquidity. Sorry, my pocket's vibrating, so forgive me for that. You know, there's over £200 billion worth of additional liquidity. Banks are sitting with this, and large institutions are sitting with this, with nowhere really to go apart from the mortgage market, and that's helped fund the reduction in the actual rates that are being offered. Now that may change depending on what happens tomorrow. We've seen a little bit of an increase in some of the rates on certain LTV brackets. So we've got a perfect storm of lots of additional liquidity, a stamp duty holiday, a pandemic that's created a bigger urgency and a bigger need for clients to want to reassess their living circumstances and buy properties perhaps outside of the city. So all of a sudden we've got this, as I say, perfect storm where lenders are competing against each other to try and take that market share. But outside of the top six, we're still enjoying a very strong year for business. We are going to grow beyond what the normal natural market share is going to be for this year. So there's definitely opportunities for us. And really for Coventry Building Society, it's about sticking to what we're good at. We're good from a transparency point of view. We are very well known for certain parts of the business. Service has been a standout element for us, and we've been very, very passionate about making sure our service is where it needs to be. During the pandemic, our average call wait time was 26 seconds into the intermediary centre. So it's interesting hearing about technology and people waiting on the phone for 10 minutes. We introduced web chat, and our average web chat wait time was 20 seconds in 2020. If you think about it from this year, 75 seconds is our average call wait year to date, and 52 for web chat. So we want to be there, we want to support. People will use us for service, and people will use us for the transparency.
You need to go on question time. I tell you what, I've asked a question and you've just sold Coventry. I love that.
Sorry.
But anyway, no, that.
Wasn't intended.
Tim, from a small building society perspective, back to the question, have you sort of felt this, and what are you guys going to do to make it different?
We felt it slightly in terms of, I think what we've seen is more lenders or larger lenders coming into the area where we operate a bit more in. And obviously they can have maybe lower rates than we have. I mean, the good news from our perspective, we're a small building society, is we don't compete with the top six. Don't pretend to, and we never will do. And I sort of say, well, why do people come to us? Well, people come to us because we do mortgages that the top six lenders won't do. So it's a sort of different market for us to operate in. And I think from that perspective, it's really good. I mean, we're on record lending for this year, and it's only going up. We've had a really successful year. And like I say, we operate in what I would call a specialist niche market where people will not go to a top six lender. They'll come to people like us. And I'll give a shout out for a few other small building societies. I mean, Lifter's here today. We're there to help you with those cases, but the big six won't help you with. So come to us.
And someone then, Jeremy, who's sort of top 10-ish, you're just outside that top six. Are you the ones feeling a pain then?
No, so I think the numbers in some ways don't really matter. It doesn't matter if somebody does 70%, 80%. The thing is for the market is the choice. And I think what we get very hung up about is the top six lenders, how much business they're doing at what price. But that business in a lot of ways is fairly straightforward. It's around price, it's around cookie cutter, it's around volume, it's around, if it fits and it looks like this, then we'll do it and we'll do it cheaper. And that's fine, the market needs that. The market also needs those lenders outside the top six. And we want to be the chosen alternative to the top six, and that's just a different strategy and different way of working. And I think the main thing for you guys is that you've got choice. You've got lenders who do that really quick, easy, 60% remortgage in 10 minutes at a price that works for the customer, and that means that customer doesn't go back direct to the lender or it doesn't go back somewhere else. And there's a lot of just maintenance, and that's fine, you still get paid, it's a good deal for everybody. But I think what we have to do then is look at what the choices are and what the alternatives are. And for guys like ourselves, it's making sure that we are that alternative. We have really good quality products. We are a bit different. We can do individual underwriting, and we can take a look at something that allows you to continue with those cases nice and quickly, but you can still look after your customer base. So I don't think the numbers matter. It can go to 80% if you like, but it's mainly where those customers are. And the customers will find the right route. We've had a great year, but it doesn't matter on those numbers, to be honest.
Thank you. So, Simon, I take it back to the BDM. Do you think the role has changed? And more importantly, how best now do brokers and BDMs interact? How can advisors get the best out of their BDM?
Well, I think going back to the point I sort of made earlier, that the best BDMs aren't primarily an escalation point or a criteria dump. They can do those things for you as a business, but when they become more of an advisory business or somebody that can help you place a difficult case, then that's where they add the value. But we are in a situation where we've created, in the last 18 months, the fact that BDMs have been massively available to brokers because they've been working from home. Their job is back out in the field now. And one of the things we have to be aware of as an industry is the fact that they're not going to be sat at the end of the phone waiting for a call to come in instantly. Now, there's different avenues, and we talked about this, I think Neil was talking about it as well. You know, there's different avenues that we put in place now to help with some of those. So one of the things I'd ask you to talk to the BDMs about is about how they work, how they schedule their time, what they're doing, but then also investigate with them, well, where else? If I can't get hold of you, where's a really good source of information? You know, we've got live chat, we've got people at the end of the phone, we've got emails, we do little bits of live chat sessions with underwriters. All those things add value. So the BDM's job is now back out in the field, and that's where they belong, because that's where they can absolutely add value. But just be prepared for the fact that they're just not as available on the end of the phone as they have been for the last 18 months.
Brilliant. Building on that and a bit of what Jeremy said earlier, Jonathan, this time, lenders and advisors working together, what do you see the future being? How can advisors and lenders really work together to drive some of the efficiencies and take out some of the stumbling blocks that we're currently facing?
Yeah, I think reinforcing what's already been said by Jeremy and by Simon, think about a BDM as a business consultant from any lender. How many times have you asked a BDM, what's your own internal view on this part of the market or this piece of legislation or this trend that's occurring? Because actually within all of the lenders on the stage and across your whole panel, there's a wealth of experience that perhaps is available for you to tap into so that you can better educate your clients. You can form some of your thinking in terms of helping the client through the next mortgage, but also sort of their exit plan, be it for buy-to-let, whether you want to go down that commercial limited company buy-to-let or normal buy-to-let. So I think it's using your BDM for the research and the resource that they actually entail, because if you're using them just for that escalation process or for basic criteria, there are lots and lots of systems on the market that are available today, and they're available 24/7. So Smarter, so Criteria Hub. I'll use the old the old term for it. We've got lots and lots of available systems that you can actually check this and do it a lot more efficiently than waiting on a BDM. But a BDM is there to help show you how to do business in a better way, what the market intel looks like, different solutions. Push BDMs for more than what you're getting from them is what I would say.
Brilliant. Just pausing there. Anybody got any questions? We've got 4 great lenders. Brilliant. A question here at the front, please. I don't want to hog the mic. I'm quite happy to.
Just the environmental side. Obviously, the government has said that by 2030, pretty much everyone's house is going to have to be a C-rated, which on average is going to cost about £25,000. So I'm just wondering if you're kind of thinking already about how you're going to enable customers to borrow easier, cheaper money on top of the mortgage they have at the moment, because they're going to need to.
Jeremy, because you've got an IMLA perspective as well, do you want to take that first?
Yeah, it's a huge topic, and we could do a conference on that, I think, on its own. But you're right; it's the right conversations that are being had. It's the right questions that are being asked. We have to get our houses better insulated. We have to build better houses, and there's two facets to it. One is we have to make sure every house we build going forward is as green as possible, and that's something we can control. We can control what we get our developers to do. We can control how they build houses, and that's really important. And I think that's probably in some ways the easiest thing to fix. The bit about retrofitting properties is the massive question that everybody keeps grappling with, and there's regulation coming. There's a paper coming out later this year, before the end of the year, around the Bayes consultancy, which is what does the market have to do. Now, who pays for that is another question. You could force this through regulation, you could force lenders to pay for it, you could force customers to pay for it. We've just got to make sure that there's no unintended consequences that come out of that, and creating a 2-tier market where you have properties which need retrofitting that then become either unmortgageable or become properties that only certain people can buy, and you force people who can probably afford it least into those houses because they lose value and they're much cheaper. So we've got to find a way as an industry, and I don't have the answer, but that we find a way to retrofit those houses without it being a massive cost for the borrower or the homeowner. And the other point is that you can push it through onto mortgages, but a significant amount of the market doesn't have a mortgage. So you've got people who've lived in those properties for 20, 30, 40 years who have no incentive whatsoever to do anything with that housing stock, which is a significant proportion of the market. There's huge problems to try and get this, but it's a massive question we've got to find a way to tackle.
Tim, I haven't come to you much. Have you got anything to add to that?
No, I totally agree with it, and it's something I guess every lender's thinking about and looking at it, because as Jeremy says, the last thing you want is almost like another mortgage prisoner market with properties. And I guess maybe I'll throw it back to you guys as well, because in terms of your advice, if we know that EPC of A, B or C is going to be the norm, say for 2030 or 2035, you're doing a 30-year mortgage now, and the EPC rating is E, how are you going to address that as well? So I think it's a big industry issue, not just for the lenders, but for everybody.
Yes, Simon?
I would echo that point exactly. It's a brilliant question. It's probably the most topical question of our time at the minute. There's lots of papers flying around. There's lots of stuff that you can read out there. As advisors, you need to go out there and read it as well. If you look at the buy-to-let space, landlords typically don't tend to buy brand new homes in their portfolio. They've got older stock. And because of that, naturally, the EPC rating will be that little bit lower. We don't want to create mortgage prisoners. Loads of buy-to-let businesses on 5-year money. So actually, if you're advising a 5-year rate at the minute for a landlord, think about what the implication of that timeline could cause them. Have a look at the portfolio, have a look at what else they've got, and start that conversation now. You might not be able to give them the answers and the solutions now, but at least you can raise the awareness, and that's the job that you guys need to do in this space.
And lenders have a key role to play in helping educate you guys so that you can go out and deliver it to clients as well. And again, another role for the BDM in terms of what's coming down the track for everybody.
I think it's probably the talking point for next year, and we'll hear loads about it. And just for you, have a think about your business. So consumers will be looking at your websites, consumers will be looking at you. What's your statement on green or climate? Have you got something on your website? What are you doing about it? What are you thinking about it? Now's a great time to be curious, because people will start choosing advisors, they'll start choosing lenders, they'll start choosing mortgage clubs based on green credentials going forward. So it's worth having that in your thought process at the moment.
The other bit as well, sorry to interrupt, is that as more knowledge becomes available, tenants will start to be more aware of it as well, and will start to look for it. And when landlords start to see an opportunity, that gives them another edge in the market. So it's not just about lots of lenders, you as advisors, it's customers, and then the tenants as well. You've got to think about those people as well.
And I think it's investors. When you start to look at things like, when it comes right down to it, the thing that will drive change will be financial outcomes. And we're finding that, for example, when we're talking to investors, when we're talking to people who are looking at mortgage books, they are really, really interested in your credentials as a company. So whether you're green, whatever you have in terms of your policies as a business, investors and rating agencies are looking at that more and more, and that will drive change too. So I think that's a real positive. It's becoming a topic that has financial consequences, and when it has financial consequences, something will get done. And I think that's a real positive at the moment.
Follow the money. That was a great question, thank you. And I don't know whether we can answer the question, but has that given you some insight into the topic?
Yeah, but I was just wondering, I know certain mortgage companies are thinking about if you did an additional loan, if it was for, say, a heat pump, the rate would be half or something like that. I don't know if you want to start thinking about it.
They're conversations that I reckon every single one of us is having these conversations. And it's right, and that's where there's going to be some innovation in this space, because there'll be incentives for doing things that will improve the EPC rating on a property. Not just for having a property that sits in A to C, but something to get there. There will be some innovation in that space. I'm absolutely convinced of it. And it won't be far off.
I'm excited about some of the conversations that we're having. What I'm finding is no one's got any answers. But I think, I think now it's about being curious, and next year we will start to see movement on this, which is a good thing. Is there any other questions? We heard technology's been a massive theme today. I won't come to Jeremy on this one, we've heard his thoughts, but what are you as lenders, starting with you, Simon, what are you doing for technology and how important do you think it is?
Well, I think the fact that everybody's talking about it and have been talking about it for a number of years, it shows how important it is, but it also shows how difficult it is to get it implemented as a lender. The interesting session for me was the one that Neil just did about the fact that there's a lot of opportunities there for you guys to go and grasp. And I don't think, I mean, we've just implemented a CRM within our business as a lender, and that gives us no end of value about being able to track leads, track what's happening, the conversations, the value add for us as a lender, because we can have a conversation today and we could lose it. We could lose that track of where that's gone, but actually with the CRM, it tells us where that conversation's gone and actually gives us a return on the investment in it as well. So those sort of things as a lender is really, really useful. I'm trying not to mention the P word, but in the last 18 months, if we hadn't had live chat, for example, we would have lost no end of contacts with our brokers. So we're looking at trying to improve that and extend it further across all the brands within the group, so within Precise and InterBay and Kent Reliance. So technology is just an ever-growing conversation. But I think Neil was just saying in his session, have conversations with some of the people that can provide you with free solutions. There's a lot of free solutions out there that will just get you stepping into the market. And then as you get in there, you'll start to see the value of it.
From a small building society, these API integrations, they could end up costing millions and stuff. So from what's your perspective on tech from a smaller building society, and what can we see in that environment, Tim?
Okay, so we're actually going through our own internal transformation program at the moment, so with our core banking supplier. And when we've been doing that, we've actually been thinking of you, the brokers, at the heart of what we do. So how can we make it better for you? How can we improve it? And hopefully, very soon, there'll be an announcement in the next few days, which will make a real difference to you when you send cases into us. So it's very much about that. But we are obviously, one of the smallest building societies there is, and so we haven't got the money. We haven't got we're able to spend it. Well, that's why we need people like Neil, for you, and everybody else to help us to develop the technology that we can use. And we've made great progress, actually, and I'm really impressed with where we will end up by the end of the year in terms of technology. We put a lot of time and effort into it, and I think you as brokers will see a big difference when you deal with us in the future. But it's a cost, it's a big cost, and we have to work with other building societies who work with us on our core banking platform. And if we can do that together, obviously we share that cost, and we can develop it and enhance what we do and become more digitalised.
Thank you. And chipping in, Jonathan, from a Coventry perspective, that sort of tier 2 band, what's tech mean for you, and what will we see from you over the next 6 to 12 months?
Yeah, tech is incredibly important. Clearly it needs to be fit for purpose, and the purpose ultimately is it what the broker wants, and is it what the client is going to benefit from as the end user? We, like Tim, we're going through our own internal transformation project with regards to our mortgage platform. We were the first to have a case submitted through the Lend Expert Now submission brain. So we do have some API capability. We are looking to extend that out further. But it's the adoption from the wider broker market in terms of using CRMs and using the submission systems, will only spur us as well as other lenders on that journey. So it's a significant investment, but it's absolutely the right thing to do.
Brill. 5 middle-aged, middle-class men. Shall we talk about diversity? Are we able to talk about diversity? Have we got a question? Oh, sorry, I didn't see your hand.
It's not that important, I bet, really, anyway. But more a question for Tim at the Buckinghamshire Building Society. Your words before, when you asked about, are you concerned or that you're not in the top 6, maybe? And you say, no, the business that we're looking for, the top 6 won't do. And with us, speaking with other smaller building societies, they say exactly the same thing when we ask them. We're not after that type of business. So we've just placed some business with a small building society, not yourselves, which I think some of the typical adverse lenders might have said no to. So the question to you, Tim, is really, are the smaller building societies becoming the new adverse lender?
In part, we are an adverse lender, but I would say our range of products and what we can do is more than just adverse. So, rather than sort of going into everything that we do, we have a lot of different products doing a lot of different things. Adverse is one of them, but I'm sitting here with my colleague to my right who probably does a lot more adverse lending than we will ever do in the team. But it's something, because we do manual underwriting and we can look at things differently, and we can take a view. We don't do a credit score, we do a credit search. We can just take a view on things, and I think that is a big difference that small regional building societies can make. It is manual underwriting by definition, and we have people there who can apply a human approach, a common sense approach, and look at the big picture. And I think that is very much relevant today and will be relevant tomorrow.
That's the beauty of a credit search lender and a manual underwriting process is, again, not trying to use the P word, but in the last 18 months, people have had blips, people have been changing their careers, they've been, self-employed incomes have dropped, and then they've come back again. The beauty of having lenders like Tim's and places like ourselves is the fact that we can take a view on that. And that's got a great place in the market. So even though we don't sit in the top 6 either, but we still continue to look at, adverse, tiered adverse, we look at shared ownership, we look at all the bits that just doesn't quite fit on the high street. And that's fine, and that's a great job for you guys because, again, you can put them with a lender like ourselves, Buckinghamshire. It might not be the most attractive rate in the market, but in 2 to 5 years' time, if clients pay the mortgage, keep themselves on the straight and narrow, nothing changes, they're back on the high street.
Is that good?
Thank you.
Right. Another question?
Just on a general point of adverse, everyone in this room must have had people a couple come to them, and one party's got good credit and one party's got poor credit, and they say to you at the outset, the partner won't be able to go on the mortgage. And I say, well, we'll see about that, because most of the time I do manage to get people on a decent product when they don't think they will be able to. But just from the industry point of view, it's always been a bugbear of mine. Why would a lender lend to one party and not the other? If the household budget is going to suffer because that other person, it'll suffer whether they're on the mortgage or not. Get them on the mortgage for the joint and several liabilities. It's better for everyone. Your lending is not more sound by the fact. It's as good as it's by the fact the other person isn't on. It's as good as its strongest link, a mortgage. It's not like the old days when I worked in the bank and you were assessing whether to let a second party onto a current account and give them a check card where they could go mad. A mortgage is, in that case, the bank account was as bad as its weakest lender, but a mortgage is as its weakest party. Sorry for the length of the question, but no. A mortgage is as good as its best.
Yeah, a good question. Who are the lending underwriters? Who wants to go into lending underwriting policy here and tackle that one?
I'll answer from our point of view. So, if we have 2 applicants and one's got good credit, one's got bad credit on the search, we would still want both people on the mortgage. We wouldn't, because from our perspective, that is, mortgages in joint names. And we turn cases down where people say, well, actually, we want this mortgage to be in sole name, but husband, wife, whatever it is, we don't want them on the mortgage because they've got bad debt. We wouldn't do that. So from our perspective, if one's got good debt, one's got bad debt, we would do an assessment of whether we can lend or not. And obviously then the product will determine based on the credit. But that's how we would approach it.
I think it's madness to do it because one's good, because it'll go bad if the other party's going to bring it down anyway.
So we've got one that will. Is there any lender that doesn't, and have you got reasons for that, or?
We're in the same space.
You're all in the same space. Maybe we've got the wrong lender panel here to answer that question.
I mean, there's at least 2 big banks that will put one party on, even if the other party's got poor credit, and there's just no sense in that at all. I just think there should be a big conversation at the top level about that, really.
Well, let me know which lender or whatever, and if they're on the panel, one of the future panels, I'll make sure we get that question for them. Is that all right? I'll speak to you later. Any other questions? No, I've got one, a sort of precursor there. I'm quite passionate about improving the D&I in this industry, and can 5 middle-aged, middle-classish men talk about it or whatever? But what are your views, and what are your organisations doing to improve the D&I of this industry? Jeremy?
I think it's in one of those other big topics and conversations that's up there with the green agenda. It's so important we get this tackled. The Amy research report is fantastic. I think that's brilliant research, and the comments in there, as you said, are quite uncomfortable when you read it through and you see the quotes that are coming through from the industry. It is concerning, but you said a lot of people aren't surprised about that. So it's what we do about it. I think what comes next from an IMLA perspective. We've done some work as well, and we've worked with Amy to support that research. But it's what's next and what's coming. I think as an industry, you look around the room, it is a more diverse audience than it was a few years ago, but that doesn't mean it's where it needs to be. So I think what will happen is we are seeing improvements and changes and people talking about it more, but the action that comes off the back of that now is how employers and how companies and how individual firms take that forward. We do a lot of work at YBS around understanding the benefits of diversity within our business. Where we're based as a company is in Bradford. So our colleague base in Bradford is a much more diverse group of colleagues than you would expect from someone that works in a different part of the country. And that's fantastic. But what we're not seeing is enough progression through the business to higher levels. And I think that seems to be the area that we need to tackle most. It's not necessarily about a lack of diversity in companies at grassroots levels. It's around the progression and the leadership of businesses going forward. Now, we're of an era. However, when you look at who's coming through behind us, that's the bit that concerns me. How do we promote diversity at leadership level across our businesses? And that's work for us all to do. Good initiatives in place, but as I say, that's the next. We have to get that right, because the people who are coming behind us have to look different to us.
I think there was a really good piece in the report. It was all excellent, and if anyone hasn't read it, they should absolutely take the time to read it, because, as Jeremy says, there are some quite startling parts in it, and actually it's an eye-opener in terms of what can we all do differently and how can we continue to improve this. But it's around the culture add, not culture fit. Yep. It's about trying to build upon what's already in situ, because diverse thinking, diverse cultures, be it from a gender, from a race, from an orientation perspective, they add so much more to the mix than the standard middle-aged white. I'm going to say bald. I'm probably the only bald one here. But there's so much more to do, and it's not just something that lenders need to think about. It's something that the whole society needs to think about. Everyone needs to lead by example, and everyone needs to have a zero-tolerance policy against racism, ageism, whatever that genderism, whatever that happens to be. It's about trying to stamp this out and actually appreciating people for who they are and what they can contribute to society. Because if you don't treat people with respect, guess what you're going to get in return?
I think it goes back to that point I was talking about earlier about customers voting with their feet as well. I think if they look at your business and it doesn't look like them, it doesn't represent them, they're going to go somewhere else. So I think as the market evolves, that's the key driver. Again, if it comes down to following the money, you look at where your customers are going to vote and how they're going to choose their broker of the future, how you're going to choose your lender of the future, and if that's the drive we have to go down, it gets the right result, then fantastic. But it's looking at what your customer base looks like, looking what our customers want, and taking it from there. We know what our customers are expecting. We need to be there quicker.
And I know what was the Amy report kind of said, great start, must do better, was kind of the general theme of it, and I think that's absolutely right. But I'll give you a really good success story. I was interviewing yesterday in London, and one of the first questions that the candidate asked me was, what does your diversity policy look like within your business? What's your culture like within your business? I've never been asked that before, and I can answer it. I can tell them what we do, and hopefully they were impressed with what we do as a business. But the success for me is the fact that an interviewee asked me that question. So the message is getting out there, and the message is getting across to people, but we can still do more.
There's was to say, I mean, internally at Buckinghamshire, I mean, at Exco level, yeah, we did actually a really big session on diversity and that challenging ourselves of how diverse are we. I mean, we all like to think we're diverse. You know, we do, and I do, or I think I'm diverse, but am I really? And it was actually a really interesting session that we had, which challenged us. And you know, from that has come some other things that we're doing internally. You know, and I mean, where we're based, you know, is probably the most undiverse. It's a village in Buckinghamshire. You know, if you think of Midsummer Murders, you know, think of Chalfont St Giles. You know, it's that kind of village. But so we don't live. You know, we don't operate in a particularly diverse area. But we need to think of, challenge ourselves, and how do we make ourselves diverse? You know, and it's easy to think you are, but are you really? And that's our challenge.
Yeah.
It's challenge and accountability. So you've articulated it really well around the challenge that lenders need to set themselves. You know, so how do you then make yourself accountable for some of those challenges? Do you set ambitious goals? You know, I don't want to use the word target because, you know, it shouldn't be about the target, but you should be setting yourself ambitious ambitions to be better and to be more diverse. And actually, look at some of the things that sit on the outside as well. How diverse are your board? How committed are they? How easy is it to speak freely about your own feelings and your own challenges? And are you frightened to bring it up as an issue? And no one should be fearful of actually raising issues around this topic.
Well, I'm going to make sure it's on the agenda. That's why I've asked the question. That's why it's there. So where I'm going, I'm going to put it on the agenda and make sure that it's talked about for positive reasons, but maybe one for the Mortgage Solutions team. It's not been terribly diverse in terms of people on the stage, and unfortunately that's representative of the industry. So it's not just about changing people on panels. We've got to change people in leadership positions so that we can actually have much more diversity across the panel. So I'll keep talking about it, and we'll make sure that we try and make some progress. So have we got any other questions? I'm conscious that I genuinely can hear tummies rumbling, so we're close to lunch. So I'm going to hand over to Vicky, but before I do, can we just have a round of applause for the lenders who want to talk about it? Can I thank you for coming and having your attention. So you've not been doing the ironing while you've been listening to one of my webinars. Thank you so much for that. That's really appreciated. Thanks for coming. Have a safe journey home, and please come and have a chat with us afterwards.